4.2%. That's the inflation number the government published on Wednesday, the highest annual rate in the United States in 3 years. If you own commercial real estate, that number probably made your stomach drop a little, and it should get your attention. But here's what I want to do this week. I want to open the hood on that number, because when you take it apart, the story underneath is very different from the headline. And the difference between the headline and the guts of this report is exactly the difference between panicking about your strip center and positioning it. This week, we got the May inflation report, the May producer price report, a 10-year treasury that did something almost nobody expected, falling gas prices, and a war that may be ending days to come. All of it connects, so let's get into it. On Wednesday, the Bureau of Labor Statistics reported that consumer prices rose 0.5% in May and are up 4.2% over the past year, the hottest annual reading since April 2023. Now, here's the part that really matters. Energy accounted for over 60% of the entire monthly increase. Energy prices rose 3.9% in May alone and are up 23.5% over the past year. Gasoline jumped 7% in a single month and is up more than 40% year over year. That is the Iran war showing up at the pump and in the index. Strip out food and energy and look at core inflation, the measure the Federal Reserve actually stares by, and you get a different picture. Core CPI rose just 0.2% in May, below forecasts, and sits at 2.9% annually. Core goods prices actually declined. The inflation fire is burning in one room of the house, energy, and not spreading through the whole structure. From a CRE point of view, your tenants' customers feel the 4.2%. Gas, food, and electricity are the prices people see every week. Expect continued caution in discretionary spending. But lenders in the bond market price off core, and core at 2.9% is the calmest part of this report. That's why borrowing costs didn't really blow out this week. Read your rent roll the way the bond market reads inflation. Separate the noise, energy-driven pain, from the signal, underlying demand for necessity services. Now, one day after CPI, we got the producer price report. What businesses pay before costs even reach the consumer. And this one ran hotter as well. Producer prices for demand rose 1.1% in May and are up 6.5% over the past year, the largest annual increase since November 2022. The detail I keep coming back to is what the BLS calls Stage 1 intermediate demand, the rawest inputs at the very start of the production pipeline. That index jumped 3.2% in May, the largest one-month increase since the government began calculating the series in 2009. It's up 12.3% over the past year. Diesel, jet fuel, industrial chemicals, the energy shock is loading cost pressure into that pipeline. And here's why that matters. For the second half of the year, pipeline costs don't stay in the pipeline. If the war drags on, those upstream costs work their way downstream into freight, into construction materials, into your tenants' cost of goods, and eventually into consumer prices the Fed has to respond to. If the war ends, much of that pressure decays before it ever arrives. And one footnote for those in the audience, buried in the same report, gross rents for retail properties showed up among the declining prices in May. 1 month is not a trend, but it's a data point worth knowing exists, worth watching. Now, PPI is your early warning system. A record jump in raw input costs means second half 2026 inflation depends almost entirely on how the energy story resolves. For owners planning capital projects, construction inputs rides this same pipeline. If you're pricing a roof, a parking lot, or a facade package, the bids you get this summer reflects these costs. And what about a tenant health check? Ask your restaurant and service operators how input costs are tracking. Their margins feel PPI months before your rent roll does. Now, the story behind the story. Everything we just talked about, the 4.2% headline, the energy index, the pipeline pressure, traces back to one place. The Strait of Hormuz, closed since the U.S.-Iran conflict began in late February. Roughly a fifth of the world's oil moves through that waterway in normal times. America's inflation problem in 2026 is, at its core, an energy problem. and the energy problem is one waterway wide. This week, the story moved. On Thursday, President Trump said the war was, in his words, basically settled, and that an agreement could be signed within days. Oil fell hard on the news. Brent dropped as much as 5% to its lowest level since the early days of the war in March. And by Friday, Iranian state media had published what it described as a draft agreement. The president disputed that the published text matched what had been negotiated, but Pakistan's prime minister, who had mediated the talks, confirmed that a final agreed text has been reached. The core of the deal, reopening the Strait of Hormuz. As of Friday, WTI sat around $84.76 and Brent near $87.44, both down again on the day. Now, markets have heard near-deal signals before, repeatedly since March, and no deal has been signed yet, so a dose of humility is in order. But this week was different in one respect. It's the first time the optimism came with a mediator confirming an agreed text. The bond market noticed. So did the pump. AAA reported Thursday that the national gas average fell for a third consecutive week to about $4.11 a gallon, down from the peak of $4.55 in late May. Texas drivers typically pay below the national average, and falling fuel prices are the most direct relief your tenants' customers can get. Every dollar not spent on gas is a dollar available at the Wingstop, the nail salon, and the taqueria in your center. Here's the moment that tells you what the smart money believes. The hottest CPI print in 3 years landed Wednesday morning, and the 10-year Treasury barely moved, holding around 4.55%. Then on Thursday, as the peace signals firmed up, the 10-year fell roughly 10 basis points and ended up the week near 4.47%. Thinking about what that means, the bond market looked at a 4.2% headline and decided it was not the real story, because core was tame and because the energy driver may be days from reversing. If bond investors believed this inflation was durable, yields would have surged, and they didn't. Now, running the deal math, because this is where it lands on your property, retail centers are financing today at roughly 10-year plus 175 to 225 basis points of lender spread. At 4.47% on the 10-year, that puts loan quotes in the range of roughly 6.2 to 6.7%. Now, that's not cheap money, but it's stable money, and stability is what gets deals underwritten and closed. So far, everything in this episode is outside of your control. You don't set oil prices, you don't negotiate with Iran, you don't vote on the FOMC, but there is one lever that's entirely yours, and it's the most powerful one in the whole story. Who pays you rent? This week, CoStar published a conversation with JLL's U.S. healthcare lead, Matt Corson, and on a migration that's been reshaping retail real estate. Healthcare services are steadily moving out of traditional hospital campuses and into outpatient facilities closer to where patients live, which increasingly means retail real estate. Hospital systems want their expensive on-campus space backfilled with high-value services, and they want routine care out in the neighborhoods. In my markets, I see this all the time, and we're actually working on a couple deals like this. And I'll tell you what it looks like from the advisory side of the table. The urgent care, the dental group, the physical therapy clinic, the imaging center, the vet, these are the tenants competing for end caps and inline space in well-located strip centers, and they behave differently than almost any other tenant category. They're sticky. A medical tenant doesn't sink six figures into plumbing, electrical, and build-out and then relocate over 50 cents a foot at renewal. Their tenant improvement investment anchors them to your address, and their patient base anchors them to your trade area. National medical platforms bring institutional-grade covenants, and even independent local practices typically post stronger financials than independent restaurant. And they have traffic. Medical visits are booked, recurring, midweek, daytime traffic, the highest quality footfall your other tenants can ask for. The patient who comes in for a 10 a.m. appointment picks up coffee on the way in and lunch on the way out. Here's the tie back to everything else in this episode. Medtail demand doesn't move with gas prices. Nobody cancels a root canal because crude went up. In a year where the macro story changes by the headline, healthcare anchored income is the closest thing to inflation-resistant cash flow a strip center owner can have. So let's wrap up with this. The scariest inflation number in 3 years turned out to be a war story, not a demand story. The bond market knew it, and that's why your borrowing costs ended the week lower, not higher. The pipeline data says the second half depends on whether one waterway reopens, and none of that is in our control. What is in your control today is the durability of your income. The owners who come through this stretch strongest won't be the ones who predicted the headlines. They'll be the ones whose rent rolls didn't care what the headline said. If you want a second set of eyes on your center, your tenant mix, your lease maturities, what your property would command in today's market, please feel free to reach out. Love to have that conversation with you. I'm Ray Kang. This was Retail Weekend Wrap Up, and I'll see you next week.